I probably, more than most, understand the delicate balance you're trying to strike here and the hard work that has gone into this. As most people know, I was non-renewed. I am now, I think, last I checked, the only of the 120 members on the FAIR plan. And when I called my broker recently, because I'd read some of the news articles, I think the chair even shared with me about people re-entering the market, my broker literally laughed at me and said, well, not where you live. That's never going to happen. So, I mean, I appreciate that we're sitting here worried about the insurance market, and that is critical. I was saying long before my non-renewal, frankly, because I was hearing from my constituents, we know we live in a higher risk area. We're willing to pay more. We understand that. Why doesn't the market work? Why aren't we letting the market work? And so I want to say that I am a believer that the work we're doing to make the market function is critical. I also think that the commitment that was made years ago when we started this process, that we were going to allow insurers to start to do risk modeling and raise the rates beyond the approved rates if they were willing to take on some of the risk, is the commitment I understood we were making when we went to risk modeling. I'm concerned we're not fulfilling that commitment, frankly. And that's how I come at this. And that is because my own broker laughed at me. And when I read what had happened in the regulations, and I want to really dive into the distressed areas question, because my understanding was that they were going to have to write 80% of their policies in distressed areas. Frankly, that seemed high to me, but great. I'm in one of those areas, so that was beneficial. And then when I started to read what actually happened, I have questions. How did we decide what a high fire zone was? How does that overlap with these distressed zip codes? I understand my zip code doesn't even count, despite the fact that we had the highest number of non-renewals in the state. So that's confusing to me. And how are we going to then depopulate the FAIR plan? Because as we saw in LA, ratepayers bailed out the FAIR plan. That's what happened because it couldn't withstand the risk that it had borne. And when we talk about depopulating the FAIR plan, part of the reason we're doing that is to make it work for consumers across the state. And my FAIR plan cost just went up, as I'm sure many people did. And I still don't think that if there is a wildfire in my neighborhood, the FAIR plan will be able to withstand it because so many people have now been put on the FAIR plan. And then I learned that we're not even covered in this 85%. So how is that all make sense to you? And how does that mean that we are going to make the FAIR plan function the way it was originally intended as an insurer of last resort, not the main insurer in areas of risk? And how do we make sure that people in those communities can get back into the admitted market?
Perfect. Great questions. And so we'll talk about the New York Times article that you're talking about. And that's great because they got it all wrong. So let me explain to you how the earlier part of my testimony is that we are now moving into the implementation of the sustainable insurance strategy this year, which was always the case for us. So we are just implementing what we passed the year before.
Right. I'm just talking about how the regs will function in the future.
No. We're implementing it now. And so the report today is letting you know what insurance companies' SIS filings were just approved to show you the commitments that are now going to be that they just got approved to meet those numbers. And then I'm going to explain to you the wildfire distress areas.
Okay.
And then I'm going to, off the record, after this meeting, get your zip code and exactly tell you why you may or may not, that zip code, not qualify as a wildfire distress area right now, and why that may change because we're always updating those numbers.
Well, and I guess I should also say that when you started the regulations, we looked and I did qualify. And as the regulations progressed, we fell off the map.
Yeah, because that means...
not because less people were on the FAIR plan.
Well, that is exactly what probably happened.
No, we've increased. We have not decreased. The regs changed.
The regs did not change. So, so since now that we've approved, since we finally now moved into the implementation, we have a big market share of California riders that are now approved with the guarantees under the SIS to grow in the wildfire distress areas. So I mentioned this earlier. The number 2 largest homeowner in California, Mercury Insurance. 3, CSAA Insurance Group. 12, 13, 19, and 24, USAA group companies. Number 18, Pacific Specialty Group. 30th, California Casualty. There's 3 pending approval. Number 5, 6, and 9. These are 3 major homeowner insurers. And then there's pending a commercial multi-peril filing, number 16. This is the kind of across all top, middle, and specialty segments in the market. And these are all have been, every of these filings to date have been completed within the 120 days, which is the fastest, most transparent, and most accountable rate review in California that California's ever had under the rate filing, which is, as you remember, one of the biggest
and
issues.
huge kudos to you for that, I want to say, for sure.
So we were able to get that done. So now that those are approved, those go into effect.
Yep.
And now we're going to start tracking where they start growing. So we're going to start to see those. And that was the report, because now we finally got those done. And we have more of those companies in the pipeline. And then how we came up with the distressed areas, that these regs have not changed whatsoever. So again, there's three criteria. Again, fair plan policyholders with moderate to very high risk, high risk. That's statewide. There's zip codes with greater than 15% fair plan penetration rate, or high or very high hazard, and then counties that have above 50% percentile of structured risk scores. And so that ensures the relief reaches the areas with the highest concentration. And so I know we did an update of those maps, and that kind of slightly changed. So I don't know if that might have kind of changed that one specific zip code, because I know we got questions from a couple of other assembly members, but I don't know if you want to further elaborate on that, because the criteria I know has not changed, but I know, how often do we update that data?
So again, Mike Peterson, I'm our senior deputy at the Department of Insurance on Climate and Sustainability. So I think that just as a starting point, if you are in the FAIR plan, you have fire risk, you're eligible under as part of the distressed areas. So that is where we want insurance companies looking for policies. That's the incentive to do that. We updated.
But can I just ask a follow-up question on that? Nothing in the regs requires them to take people off the FAIR plan. It merely requires them to have 85% in the distressed area maps as you define it, is my understanding.
In the regs, they have to make a commitment that can be to write 85% or to grow 5%, and then it's who counts towards that growth or maintenance. So as a FAIR plan policyholder in a moderate to high fire risk area, that counts as a policy. So that is one of those policies that would go into those commitments. We make the insurance companies keep the data, and so we hold them to those commitments.
So FAIR plan, no matter whether you're covered by the maps, if you're on the FAIR plan, you count towards 85%?
If you have that moderate to very high risk, yes.
Moderate to very high fire risk.
Fire risk,
Right.
yes.
And those maps, the fire maps, were not Department of Insurance maps. I assume you're relying on somebody else's fire maps, or are they your fire maps?
No, so for that FAIR plan policy, that's the risk score for the FAIR plan policy.
Oh, got it. For the FAIR plans defines me as moderate
no, the risk
to
score
high.
is used like by many companies all as one, not the FAIR plan itself, but the risk score system that they're using.
Okay. So those are not maps that are drawn by an agency.
No, and if I could just add one more thing, it's important because the challenge with California is we have big cities, small towns, and so the population centers can wash out or dilute any effect. If you said, this area, city A, is distressed and there are 1 million policies in it, insurance companies aren't necessarily going to be able to find the needles in the haystack of the FAIR plan policies. But if you say every FAIR plan policy with fire risk is eligible, then they can target those policies either by looking at their difference in conditions, policyholders, or elsewhere. So it's sort of our way of trying to reach those areas that don't match the maps as perfectly as other areas might.
Got it. So I appreciate that. But okay, so let's use the example of Berkeley or Oakland, right, which has very high fire risk hills and also some flats where the risk is negligible. My understanding is that the entire zip code, despite whether you're in the high fire part of the city or the low fire part of the city, would be covered by that 85% because it's in the zip code. Am I right or am I wrong?
I mean, that's one of the criteria. But if they are in the FAIR plan and they have a high risk area in the high risk number, they're covered.
Right. But if I'm an insurance company and I'm trying to maximize profit and reduce risk, and the people who are in the low fire areas in those zip codes in the flats where there's less fire risk in downtown Oakland, for example, versus the Oakland Hills, I can count that towards my 85%, which is the choice I would make because it's less risk. That's a logical business decision. And that would count towards my 85% because it's in the zip code. I think that's what the New York Times was saying, and that's my understanding of the regulations. Am I wrong? Because I would love to be wrong.
I think that the particular example is not accurate because the Oakland Hills are not in the zip codes that are covered. So it's the Fair Plan policyholders in the Oakland Hills that would be eligible. But we don't have those zip codes covered for that very reason, is that the greater population in the lower risk areas would wash out the effect. So that's why we designed it this way, is that exact situation.
So the zip codes are not at all covered by your distressed areas.
But the Fair Plan policyholders are. So that's our way of tailoring to this urban-rural challenge.
So the number of zip codes in the distressed areas is almost a quarter of California's zip codes, 600 and something, which is a quarter of...
I mean, somewhat,
right?
Yeah.
I mean, I just looked up how many zip codes there were in California, and it's about 2,600.
No, that's accurate.
The challenge with the zip code is because they were made for like postal.
Yes,
so
right,
this
exactly.
Is why we were
it's not great.
We were trying to come up with some sort of hybrid system that would capture the zip codes, but then capture this whole big city issue. And look, at the end of the day, I remember Bauer-Kahan, we're going to have the data to monitor how the insurance companies are reacting to the wildfire distress areas. Something we didn't have before, as we're attempting to launch these first ever regulations. And then, quite honestly, like I told the Times, we're expecting them to try to, find loopholes,
make logical business decisions, as I said.
Right, but name one regulation and one bill that has been perfect from the get-go. We're gonna constantly be monitoring it to try to tweak it so that we capture these anomalies, right? And that's what I kept telling the New York Times. Can you come back a year or two when this is actually implemented, and then help us, look at these loopholes? Why are you already, looking at these? Potentials when we haven't even implemented any of this stuff. So we've been trying to come up with these formulas to try to capture all these different scenarios, but we haven't implemented any of this until this year.
Right. No, and I appreciate that. I do think, look, I'm not going to throw shade at the journalists who are trying to keep us honest. I think it's important. But I do hope they come back, to your point. Yeah. I think they should continue to the journalism and continue to maybe admit they're wrong if they're wrong, which is why I said I invite you to say I'm wrong. So I guess, the example I gave you is a regional example where I am, obviously. But they gave an example in that article of, I think it was the Sacramento area, where a similar thing would happen, where they could concentrate in lower fire risks and get their 85%. You think that's not true? I mean, is that what you're telling me? Because
Go for it.
I think so. So I can't speculate as to everything that will happen, right? But let's say that 10 companies decide that that's what they're going to try to do. They would be competing for that business, and that would drive other companies into the other areas. If we are able to get all 118 companies to participate in this, collectively, they are going to have to reach all of these areas. And so I think that's the key, is one company can try to find a path, but all these companies together are going to have to write in more than just the flats in order to meet the commitments that they are making and that we're holding them accountable to. And like the commissioner said, if we're tracking this through data, we're going to figure it out, and we will update the distressed areas once a year. Or at least once a year. So if we do see that there is a pattern that's emerging, we can address it.
And then so you mentioned, which I was going to ask about, so it's 85% or 5% year over year. What would that entail for the companies you've already approved? Like, what percent are they currently at in distressed areas? Do you know?
We don't know, because we are just implementing this as we speak. This is why we're giving you an update today.
So that wasn't in the rate Will you approve the? So I just thought maybe that was in the rate application.
We've literally just approved these rate filings.
Okay.
And we're just about to launch. We're now in the implementation, the beginnings of the implementation stages of the SIS.
Okay, so we don't know how many years it would take for some of these companies to get to 85% if they did 5 year over year.
No, the plan is to get as many companies as possible to start getting the rate files in. And so today this is why we're saying we're speeding up our rate file process so that we can get these done as quickly as possible, so that we can get as many companies to submit their rate files, getting them approved. And we're starting to see that the companies, the worst case scenario, which I would always tell the chair, is we set up all this system and nobody comes to play. But we're seeing that companies are coming in, and actually some of the biggest writers in the state are coming in, making these commitments. So now we're going to start seeing.
Well, and it's going to raise rates. I mean, let's, and I, like I said, my constituents for a long time have been saying they want the market to work. And in order for the market to work, we need to be paying for our risk. And so, I understand why they're coming to play. But we've got to make sure that we're fulfilling the commitment of insuring Californians as a result of that.
What would be the other option as a member, that we actually hide the actual true cost of climate, or that we defer the cost and then we have another massive climatic disaster in the state, and then we go insolvent, and then that really harms the consumers. And so I could sit here and do what's politically expedient or do what's hard, and then ultimately get more insurance companies to come, and then eventually drive the cost down for consumers. And you just got to open the paper and see how climate change is changing our market here. And so I could do what other commissioners have done in the past and just hold on to the rates and wish for the best, but I can't do that. And so we're all in this together. And the rate has to reflect the risk, and we all have to pay for fair rates and for where we live. And that's the hope. And so, but by getting more companies to come in, we'll eventually get the rates to come down. And this is what we're saying. It'll take us, 3 to 5 years to hopefully stabilize the market.
Well, and I will say I was not suggesting that we not do this. I've been supportive of,
right, no,
as you know. And also I will say the status quo was not keeping things affordable. When I got dropped, my cost went up 300%. So not having insurance was not an affordability scheme. Let me just clarify that for people like me in California. So I think, last question. So I appreciate what you're saying about tracking the 5% to 85%, whichever they choose, and really seeing how that works. What kind of transparency will there be around that?
Yeah, no, our plan is to make sure that when we have these updates, we're going to be posting it on the website. And you want to clarify on how we're going to, because we absolutely want to make this transparent, and we want to make sure you all know, and that we use this tool. Again, this is also important as we're developing the public wildfire model, so that local governments know how to use the tool. Mm-hmm. We know how, and this is going to inform local planning issues, how we build, where we build. Mm-hmm. So go ahead, Mike. That's a great question. Yeah,
no, thank you for the question. I think there's 2 areas of transparency that are good to note. One is that in the rate filings themselves, you'll see we designed a template for the insurance companies to make their commitment. So you can see we're going to grow 5% and we're going to do it in these ways. And this is where we're headed. And then in our data collection, we'll be able to kind of show 2 things. One, the distressed areas as they change, you'll see whether certain zip codes continue to increase in their fair plan percentage or decrease. And so that'll show where some insurers are writing. The second thing is that as we look statewide, the number of fair plan policies in any given area will go up or down as well. And
then we will be able to take that data and show that to you by district, by your zip code, right? Or by your county.
Yep. So, you said in the rate filing they lay out how they're going to meet the commitment.
Yes.
And then do they have to come back at some point and show that progress?
Yes. And we will,
post-approval, obviously.
Correct. And we have already the statutory. We already have, the authority to be able to go after them legally if they don't meet the requirement.
Got it. And so you'll be tracking sort of where they're doing that, and that will also be transparent?
Well, the next commissioner will be able to do that.
Yes, fair, commissioner. You're like, I'm going to retire. But so that will also be transparent is the vision?
Yes.
Okay. And how will, and you said there'll be a website or?
Yes, the plan is to make all that public.
Not going to be a binder anymore?
No, hopefully not. They do not want you walking with a binder. Yes.
I appreciate that. And if you want to follow up on our zip codes, I know there's a lot of concern in my district that this will not be benefiting the areas that are most distressed. And honestly, I mean, I do know that, we do have concentrations even within zip codes, as I'm sure you're aware, like the Palisades was, where if there is a firestorm, the fact that another part of the zip code didn't have a high fare plan will not help save.
And we'll be more than happy to talk to your staff or your constituents and dive into the formula of how we did the formula and how we could address. Because I know there was a lot of discrepancies within the New York Times article. I just wish they would have. We sat with them for months. This article that just didn't come out of the blue. We sat with them and met with them to really go through the data. I just wish they would have allowed us to implement it, to actually showcase what we were trying to do. Again, we welcome the scrutiny, but I just wish they would have allowed us to implement it first. And we were just saying, name a regulation that we're starting from zero to fully implementing this. We've never done this before. And so is it going to go right 100%? We have no idea, but we have the data now to track it and to be able to mold it as we go. And so that's the plan.
But I do think that our regulations and the models need to be defensible and show that the plan is going to be implemented as the promise was. Again, that we would allow them to do catastrophic modeling, that rates would go up, but that the market would continue to work and we would depopulate the fare plan so people don't get hit like they did after the Los Angeles wildfires.
Well, once we implement it.